Just like to be known that I made breakfast for Mother's Day yesterday. Just, you know. No, it was eggs and bacon, you know. That's what she wanted. I said, you know what? I'm going to make some eggs and bacon. And they were perfect, too. Scrambled eggs, yeah. Yeah. Saw that TikTok where it was like, you know, how dads celebrate after doing one nice thing around the house for Mother's Day, and he's like press conference, like, I just want to thank everybody, you know. It was a lot of work trying to keep the kids busy in front of the TV for 6 hours, but I did it. Hey, welcome to the Closing Beat, everybody. Happy Monday. How you doing out there? Yee, right? Hey, we're financial advisors with Jazz Wealth Managers, helping you keep your dough straight. We got the new shirts on here, and boy, that's comfortable. Feel right in this Florida weather. It feels like you're not wearing anything. Oh, it's over here. I pointed over here. It's over here. Anyways, it's been one of those days, as you may know. If you look off to the right-hand side of your screen, you can see the stock market there moving lower. You go, ooh, this is crazy. I see all the articles where people say, you might want to have some cash ready, man, you know, buy this dip sort of thing. We've been doing that since the end of last year. We actually started selling little by little as the market was moving higher. So now we have the cash to put to work while the market is lower. We manage our own funds here, so it is important to us that we do a good job, because I think we're one of the only advisors that, hey, we only get bigger as a company if you get bigger with us. And I really like that. No sales pitches or anything like that. It's gone well for us. I hope you check us out at jazzwealth.com. Fin tips this week. Today was kind of a fun one. We'll go over that in a second, but kind of a fun way to look at data as far as the market bouncing and everything. Those videos are free. We just ask for a subscription if you want. Click on that. Maybe give us a thumbs up, nice little comment or something, and we'll keep them coming for you. Tomorrow will be Eric doing his Fin tips video, so he's doing a great job. Actually, you guys have been more than nice to him. Anyways, what? Oh, man. Go like this, a little bit lower. Hey. I'm excited today, man. I'm excited. Well, the big thing this week is actually inflation. All right? The stock market has no real reason to do anything aside from stocks that report earnings and stuff. But, you know, they have no real good reason to bounce. Right, we got Wednesday. It's kind of like a Fed meeting week in a way. We're all looking to inflation. We're expecting it to fall a little bit. We're looking for inflation to come in at a nice 8.1%. We're sitting at 8.5 at the moment. Remember, that's a year-over-year number, so that's not like it went up that much. It's just compared to last year. So we're looking for 8.1%. That's what the market's looking for. I think it would like that if we saw a meaningful decline in inflation. Hopefully, it's more than that. But if we go from 8.5 to 8.1, well, it makes people think, well, maybe the Fed did something right. Maybe they're talking and their aggressive stance here is actually working, and, you know, inflation's going to go lower, and maybe a little optimism in the short term for an otherwise oversold market. On the right-hand side of your page, those numbers are right. The S&P lost 3.2% today. So last year, we got lulled into this sort of quiet, just little 0.25% gain days and maybe a 1% down day here and there, and the kids would all email and go, Dustin, the market crashed, you know. No, this is more like it, right? This is how the markets can treat you, and boy, they demand a little bit of respect, don't they? Well, it all started overseas last night, actually. You had 1% and 2% losses in Asia, Europe. Actually, Europe's down almost 5% in the last 3 days there. In Europe, by the way, in the overnight markets, there were 10 sellers for every one buyer. So you could just feel that negativity coming over to the U.S. We didn't see that much of a pain here today, but it was nasty over there. Anyways, let's start with the S&P here, because you got the S&P down about 15% year to date, right? And so I've been getting the question a lot, are we headed for a bear market, Dustin? What is going on? Well, 20% would be a bear market. And in honor of the Kentucky Derby over the weekend there, let's see some odds here. Let's pretend that you want to bet, and I did this on the Fin Tips earlier, you want to bet that the market's going to go lower, not higher. What are your odds? Let's take a look. This is the chart that I shared with you. You have a 37.2% chance of the market going lower over the next 1 month. This is us looking at all the data of what happens to the S&P after it hits correction territory, down 10%. You would not have the greatest of odds. The further out you go in time, of course, you see you have lower and lower odds. You want to say till the end of the year, you've got about a 28.9% chance of being correct there. And actually, we go just a little bit further. We're going to erase all of last year's gains there. But that's what you're looking at. So when you look at the stock market and you go, oh, I can't take it. 15% down already. I'm out. You only have like a 1 in 4 chance that you're going to be right and the market goes lower. Now, when it does go lower, it could be nasty there. But something to keep in mind there for you when you're taking a look at the stock market and your probabilities of being wrong. All right, let's get rid of this here because I want to show the market here, and I got good stuff for you here today. Let's get into it. So we'll come back to that other chart in a second. Here's the S&P. We broke the lows here, obviously very extended to the downside. We talked about this in our office trade segment today. It's a little bit worse here, but from highs to lows, it's about 14%. That's just from the last bounce there, looking pretty rough there. And it's that sort of market, right? Where other companies, they're starting to suggest how they may be in protection mode. For example, Facebook today said, we're going to just cancel all hiring. We're not going to be hiring new people now. We might need to hold on to some of our dough. Uber said something sort of similar. They're going to focus on profits for a change. So they said, well, look, we maybe not need to focus on growth as much. We're going to go focus on profits, cutting costs, something about a privilege if you get hired at Uber. They said all kinds of different things there. Does that mean they're going to have an even higher take rate now? You ever driven for Uber? I hear that complaint a lot from people that do that. Ford actually took a chance to sell off part of their Rivian position. So Ford was lower on the day. Rivian was significantly lower. It's also the end of their lockup, I believe, tomorrow or today or something right around there. But Ford sold like 8 million shares. They have, I think they had 100 million or something ridiculous. So it's just a little sale off the top there for them. But that's what you had going on around the market. You had that concept of hearing from leadership saying, you know what, we might just focus on buying back shares. We may just focus on maybe holding on to some cash. I'll cover some more of that in a second. But there was a whole lot less about, hey, we're going to aggressively grow. We think this is the time for us to go out and expand and grow and all that. And that's kind of a sign of, what's going on. Now, what did not participate today, again, was consumer staple stocks. You could look at Verizon. You could look at Walmart. Procter & Gamble didn't fall as much. Kimberly-Clark, Colgate, Philip Morris, all those stocks. I don't need to go through them again for you, but all those stocks that have been holding up pretty good got more of a bid today. People said, I'll go with the boring stuff. That's fine. I don't want to be in this scary market. I'll go with the boring stuff. Give me Kellogg's, give me Kraft Heinz, give me General Mills, give me Oreos, Mondelez, right? That's what, that's one of their brands. And so you had that kind of vibe going on today from comments from CEOs as well as in the stock market. The NASDAQ was no different. It's now down 25% year to date. That is not a joke there. Look at what's going on in the old NASDAQ. The average stock in the NASDAQ, we put here, right, just to kind of show where we stand. Let me break it down for you. So over here, down 20% or more. 75% of the NASDAQ is down 20% or more. And this data was from yesterday, by the way. This was not part of that. So if we look at how bad it can be for the tech stocks, NASDAQ stocks, biotech stocks, things like that. 75% of them are in a bear market. They lost 20% or more. 64% down 30. Let's go to the scary one. About half, and this was Friday's data, right? So this it's even worse today. You could probably say 50% of the NASDAQ is now down 50% or more. So if you have those NASDAQ type positions or funds in your 401ks and stuff, this is about as bad as it's. Well, this is as bad as it's been recently. And look at as you go, 40% down 60% or more, 30% down 70% or more. It is a rough go for the NASDAQ stocks out there. Very, 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 very tough. Take a little bit look further into the sectors here. So, for example, I'll go over here and start like we did on the last one. The average stock in the NASDAQ composite, not the NASDAQ 100, in the financial sector is down 25%. So if you thought, I'll go play with those, the financials. Well, you're doing not as bad as everybody else, but it's not very pretty. All of them, of course, are about 47%, now going on 50. Look at some of this. Healthcare, the average healthcare stock in the NASDAQ, which is more biotech related, down 65%. Consumer discretionary, where we spend our money when we have extra money, down 55%. The average stock down 55%. Communication services, tech, all down 50%. Consumer staples, which are blended in the NASDAQ composite, down about 50%. It's brutal over there in the NASDAQ. So I got good news for you. The good news is, yes, we are in a bear market here for the NASDAQ. I'm going to do a research post on this as well. The last bear market in the NASDAQ spoiled us a little bit. I'll go over here. Let's see if I can go. There we go. So the last bear market lasted a whopping 33 days. This bear market, the average bear market for the NASDAQ is far greater than that, but this bear market is getting close to being average in terms of how far do we normally fall and for how long before we start to bounce. So I'll put that in the research site because there's a lot of cool little data points there, but that last one spoiled you. Don't let that one get you too excited and pretend like that's how it always is, because that's not the case. All this bearishness actually set up for a good reason for short-term bonds, for short-term notes to actually get a bounce. People came for that short duration, the 1 and 2 year sort of thing, which is incredibly cheap at the moment if you're looking to do something like that. If you look around also, you're going to find oil. That's good news. Down almost 7%, which took down every form of oil service stock. You could look at XOP, crushing blow today for that one. Energy, XLE. The USO, metals and mining also lower as well. We take a look at gold, down about 1.5%, kind of a sloppy mess and correlated to the market, which is a little bit odd. Bitcoin down 14%, good. So we'll see what happens there. I really don't have an opinion on that one. Anything gold mining related, semiconductors related, it didn't matter. You just look around, it was pretty freaking crushing out there as far as things go. As far as sectors go, 6, almost 7 sectors in the S&P are down double digits year to date. You said you wanted a discount, right? Last year, everybody's like, when are we going to get this discount? Here you go. Here it is. You're looking at you're living it, baby. You got consumer discretionary down 25%, communication services 25%, tech down 22%, real estate 17%, financials down 12%, industrials down 11%, healthcare down. Let's just call it 10%. Let's say 7 sectors are down 10% there. That's pretty nasty there. Do you agree? Now, what if you say, well, I get it, price has fallen. But let's say you look at this and you go, okay, the prices have fallen, but what about the value, right? Let's look at the PE ratios here and see, is the price relative to earnings fair, not fair, or cheap? All right, so let's take a look by sector here. So here's what we did. We plotted each one of them, and I had to have a way to put this on a chart. So I said, all right, what we're going to do is we're going to plot the PE, and then we're going to take the 10-year total range, and we're going to show where it's at in that range. And I don't know how to make a chart that shows the low end of the range and the high end, so I did it like this. Utilities, in terms of valuation, are at the 97 percentile, meaning there's only a few percentage of other times in the last 10 years where they've been cheaper, otherwise, or more expensive. Otherwise, they're at the top end of the range, right? Consumer staples, there's only a few other percent of time, let's call it 7% of time over the last 10 years that it's been even more expensive than where it's at relative to its earnings. Looking all the way to the S&P, we're about at the halfway mark here, so it's working on it. You could start to make the argument that maybe things are getting cheaper on a fundamental basis. And then as you keep going down the list here, here's your cheapies. Materials are at the low end of their range. Price versus their forward earnings, their current earnings. Financials, 11%, 11th percentile, I should say. And healthcare would technically be the cheapest. So for every dollar that you're putting in there, you're getting more of the earnings back than you would if you invested in tech or, anything, really any other sector, right? So pretty nasty there, right? It is a bit crazy. It's just kind of a fun way to look at valuation if you're interested in that kind of stuff. Let's do one more thing here. Okay, here we go. Stock price relative to its 50-day moving average. Remember, this goes back to the deal where I say I give you money and you invest it. You just have to tell me you got a good deal. That's it. I just don't want to find out that you overpaid for anything, but anything you want to invest in is fine. So if we take a look here at the price relative to its 50-day moving average, let's go through all the sectors real quick. I'm looking out 10 years, by the way, and I'm plotting the lowest point and I'm plotting the highest. This would mean that the price was most extended from its 50-day moving average, and this would be to the upside, most extended from its 50-day moving average, and we're doing this in dollars. So currently, if you look at materials, not that extended. Not a big deal at all, maybe not the cheapest area. If you look at something like communication services, this is pretty extended. How many other times has the price been this extended away from its 50-day moving average? 1, 2, 3, 4, 5, all a part of COVID there, in 10 years. Well, not 10 years because this doesn't go back that far, but it's not very common. All right? If we look at energy, no. There's nothing extended about this, if anything, to the upside. So price is moving ahead, and you know that if you looked at the sectors. Financials, looking at financials here, they're getting pretty cheap relative to their 50-day. If you were to buy something in financials, we know now that the valuation's a little bit lower. Okay, that's interesting. Price is a little bit lower. Maybe that's interesting to you, and it doesn't often like to stay this far away from its 50-day moving average. You look at industrials, nothing really interesting there. Let's look at tech. Ooh, well, you probably could have guessed that one there. Tech is very extended and does not like to stay that way. If we look at consumer staples, well, everybody's really excited about consumer staples right now, so it's basically sitting at its average. It's right where it normally does. So if you spent my money on consumer staples right now, all right, it's not impressive, but at least you didn't pay up for it. If you look at real estate, ooh, getting there. Now, real estate doesn't like to actually stay very extended. So just from a purely technical standpoint, this is probably about as far as it goes, maybe a little bit more. Utilities, basically about average. You look at healthcare, ooh, getting a little bit extended there. This is a more volatile sector and likely to be more volatile for the rest of the year, thanks to the good old midterms coming up here where we all start to hate each other again. You got consumer discretionary, very extended as well. And that's just a kind of a way to look at the different sectors of the S&P and go, is it cheap? Technically, or not? Just comparing itself to history. That's all I have for you there. That was nothing fancy. That was just a different way to look at it. All right, in the research site, we're going to post the bear markets for the NASDAQ, how that goes, and sort of the average length, the average downside, what happens with all of that. So that'll be coming up there. In our office trades, we did we basically built a shopping list because we're getting crushed. So there's really no need to do anything except sit back and cry. But we put together a little shopping list to see what we can do going forward. For new highs and lows, this is going to be correct. 91. There were 91 new lows today. Consumer staples and energy were the only sectors without new lows. Every other sector had a new low on the list today. Consumer staples would be XLP and energy would be XLE, and you now know why. There were 3 new highs on the day. Campbell Soup was one of them, getting very, very extended. We put that on our shopping list today. Kellogg's is another one, very, very extended. How often does it like to be this extended? Just take a quick look. Ask yourself that. To the downside here, you got Take-Two falling off a cliff, man. Just rolling over. Very extended here. A little bit crazy. Expedia. This is EXPE, not D. Very, very extended. It's as if nobody's ever going to travel again. Right? Everybody's, oh, forget it. The economy's done. Same thing with Carnival Cruise and Royal Caribbean. What's the deal? It's not virus-related move, right? Everybody's booked their cruises out for like the next 5 years there. But still, it made a new low, and that's what happens. All right, stocks in the news here, and then I'll take your question. Here's a cool one. Did you watch the, oops, I typed in the wrong spot. Did you watch the Kentucky Derby? There you go. Churchill Downs, public company. Did you know that? They said all the wagering from every source that they can collect money from was up 25% year over year. Obviously, they got a lot of attention because of who won, and likely that will continue going forward. The stock was still lower, not able to weather what the market had to throw at it. But I thought that was kind of cool. General Motors here was mentioned in Barron's, basically saying that General Motors is cheap. It's a good buy down here. A lot of nice things to say. That the valuation as well was one of those that they talked about. Tyson. We don't talk about this one a lot. You know Tyson. You make the chicken and beef. Believe it or not, beef, they actually make more beef than they do chicken. Anyways, Tyson, they say, here's the deal. We need to save some money. And so Tyson goes, by 2024, we're going to try to cut costs and find ways to save money to the tune of about $1 billion. Good for them, right? Not too bad. They've got an eye on what they probably should do. They said that in their earnings, they said pricing power, key word, right? I've been telling you the key word. Pricing power is the only reason that we will likely beat or match earnings for the rest of the year. Well, we like to hear that, right? The market likes to hear that. You see, Tyson is doing well. Had a good day today when the market was clobbered, right? So they go, okay, well, that's the case. And then they go in their conference call. Oh, by the way, the New York Attorney General subpoenaed us today. They have some questions about our pricing. The New York Attorney General and President Biden, they currently say, well, you guys are profiteering off the supply chain issue. That bothers me a little bit there, because since they're a public company, we can actually verify if they are profiteering, which otherwise, what's wrong with that? But if we can verify that because they're public. They had higher transport costs, labor costs, and animal costs, because, they take the animals and do their thing there. So what they're doing is cutting costs to keep and improve their margins. What's wrong with that? So they're getting subpoenaed here. They're going to get looked into this. Their beef segment, which is their largest, 38% of their beef segment, that's the biggest source of their revenue, 38% of their revenues there, has a 12% operating margin. So essentially the New York Attorney General and President Biden, who said this as well, think 12% operating margins they're too high, right? That's profiteering. How much margin will the government allow? See, that's a slippery slope. I don't like that. And to put this in perspective, Block or Square or whatever we call them again, their profit was up 30%. You know why? It was due to Afterpay. They made $92 million there from people who were buying now and maybe they'll pay later, right? So are they profiteering off of the pains of inflation? At what point would they not be allowed to profiteer? So just a weird, slippery slope there. And because these are public companies, we can prove that that's not the case. So it's getting political out there, guys. It is about that time of the cycle. Azul actually beat on earnings better than expected there, and they're going to try to expand capacity. People didn't like that, right? If everybody else is saying, hey, we're going to tighten up, we're going to save some money, we're going to try to keep our profit margins as is, we're not going to hire new people. But Azul is out there going, yeah, we're going to just plow right through this here. Yeah, I don't know. People didn't like that one so much. I don't blame them. And Coty, these guys make makeup and lotions and potions and all that great stuff. Earnings better than expected. People were spending a lot of money on overpriced makeup there, and they kept their guidance the same. They said, we don't see people changing how they spend money on their makeup, whether it is very expensive or not. That's what you have. All right, tomorrow what you've got is EA Sports. Oh, boy. That one had a rough day today, too. They're reporting earnings. Callaway Golf is reporting earnings. H&R Block, Occidental Petroleum, Rocket Mortgage. Fox is reporting. Cisco, Transdigm, and Coinbase. Yes, Coinbase. Down 2 of their only 3 earnings reports so far. And yes, that is it. That's all I would like. Now, before I take your questions, just ask yourself, what's the reason that this has to be the bottom? What is there? Maybe inflation, but we won't find out till Wednesday. If you think that this market's about to bottom, you just got to have a reason. I don't have many good reasons. I have reasons, but they're not good. And I doubt that anybody believes in it. So if you see more downside here, just say there's no reason. Why should the market bounce here? Maybe it goes sideways and we wait for the inflation numbers, but what's the reason? It's just not there, man. It's not there, man. Yep, that's a tough one. Let's see what we've got here. Oh, Plantair. Yeah, fortunately, they're in the same camp, right? They've got to cut their costs. They've got to drastically reduce their overhead. But, it's what it is, man. That's true, man. The facts are what they are, especially when you can prove them and not just make them up out of thin air. That bothers me a little bit. That's why I don't really watch the news and all of that. People will say stuff and you're like, well, that's not true. We can see what the facts are. It's a little bit tough. Yeah. Kramer said inflation's starting to calm. All right, there you go. So it is a buy. Yeah, there you go. Get lower inflation there. I think from just general shopping and being out and about, inflation seems to be leveling off. I hope that's not the case. But we don't see prices just going crazier and crazier. So that's good news. But we'll see. We'll see by Wednesday. Yep. You think a rally's coming for tech? I mean, right now, is there a reason to? You'd have to argue that it's overdone to the downside. That now pricing is already baking in absolutely every bad thing and then some, which is probably what's going to eventually cause the bounce, because we know that the Fed isn't stopping what they're doing. Right? It's just got to be that it becomes so cheap. Best time to buy is when there's blood in the streets, but they forget to tell you that that's also the hardest time to buy. Yeah. Yep. You see more downside, inflation comes in at 8.1, more than 8.1. Yeah, because then you have the same concept. Now, think about what happens if inflation comes in at 8.4 or 5 or whatever. Then you got people going, well, that means the Fed isn't trying hard enough, and they're going to have to try harder, which makes it more likely that they push us into a recession. So, we'll see. It's just funny how polarizing he is. Some people love Jim Cramer. Some people don't like him. There's nobody that ever goes, he does what he does. That's a tough one. I don't follow him enough to really get into it, I guess. But you think gas prices they continue to rise? Not so much around here. We're kind of just chopping around, as far as gas prices that I see. Yeah, those donuts are still cheap. And the soda, you go to the gas station at 85 cents with tax, get yourself a Polar Pop. Boy, that ain't changed pricing forever. Yeah. Has a $2.5 trillion trickling into the economy play a role on the recession? You think we're already there? Or I'm not sure what you're saying. Yep. The party's just getting started. All right, you guys are all excited for it. You think this is a recession? So the last GDP number was negative. We just need one more. That would do the trick. Yep. Then we get to do all those fun videos that I've got a lot of them in the, just search recession in the dojo, going through all the stats. We did that through COVID where I was like, all right, let's look at every recession, what's happened there. I've got a lot of good stuff there, but yeah, we may have to start pulling that thing out of the old binder again, huh? Yep. At what price of gas do people start driving less? That's a good question. I don't know. As long as everybody's got a few dollars in their pocket, or the majority of people have more dollars than they're used to, I guess they keep driving until you suck all those dollars out. Yeah. What in the world was that? What's the alarm for? Oh, all right. Nothing exciting? Nothing exciting. All right. Well, tomorrow's going to be exciting. There's no doubt about it. This week likely is going to be exciting. Oh, I found fascinating that last week we had all that action, and I put it in our notes from Jazz email. We did all that all week, and the market only lost 0.08%. It felt like a lot more, didn't it? I would have, not knowing that, I would have guessed a lot more. Yeah. All right. I'm going to wrap it up there, but we will be back tomorrow. We'll do this all over again. If I missed your question, we can cover it tomorrow as well as all the other good stuff going on in the stock market. Enjoy the rest of your evening, and thanks for hanging out with us.